Good morning and welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined again today by our Global Head of Macro Tactical Asset Allocation and Alpha, Hayden Davis. Good morning, Hayden.
Good morning.
Okay, so let's kick off with quite a broad question. 2022 has been an extremely challenging year for investors. What do you think were the key drivers for both equities and bonds during the year?
I think you're right to point out that maybe 2022 was the year that many people would like to forget. I think the key driver or the key theme in the markets this year has been interest rates. I'll touch on the cost of living and inflation in a minute, but it's really been in interest rates. So this week we've just had the Federal Reserve raise interest rates, the Bank of England raise interest rates, and the European Central Bank raise interest rates. And it's funny to reflect on the year and to think back to this time last year. A year ago, markets were pricing in UK interest rates being less than 1%, US interest rates being less than 1%, and European Eurozone interest rates still being negative. And here we are now. We have UK interest rates at 3.5%, US interest rates at 4%, and the Eurozone interest rates at 2%. So markets have been very much taken by surprise at the extent to which interest rates have risen. And it's not just markets that have been taken by surprise. It is the central banks themselves, because this time last year, the Federal Reserve Bank of the US was again forecasting interest rates. It would have to raise them only to 1%. Makers that have been basically thrown offside by inflation, and also financial markets and investors as well. And so that's been the story of the year. And those, I suppose, disappointing expectations about interest rates and the fact that interest rates have surprised very much to the upside have driven very much bond yields higher. So bond yields higher, bond markets lower, bond prices lower. And together with that, equity markets lower as well. And so it's really been that surprise uplift in interest rates that's driven markets lower. Now, of course, people have been talking about the cost of living and inflation. But again, if you reflect back to a year ago, UK inflation was 5%, Eurozone inflation was 5%, and US inflation was 7%. So the inflation horse, had already bolted. And really, we've been having this situation where perhaps the central banks, for want of putting it a better way, have been trying to shut the stable door long after that inflation horse has bolted, which is why they've had to raise interest rates so sharply to try to catch up the horse in the first place. But yes, just to summarize, really, the story of this year has been higher interest rates pushing down bond markets and with them pushing down equity markets.
Excellent. Thank you, Hayden. So if we start to try and look ahead now, what do we consider to be the outlook for 2023?
Well, from a market perspective, I think we all hope it's going to be a better year, and the consensus certainly is it's going to be a better year. The consensus is that we're going to have a dip in the first half of the year from equity markets, and then they're going to recover. The problem is that if everyone thinks that, that's not very likely to happen, although it's very difficult to disagree with that view, given that the UK is already in recession. We've had the European Central Bank at its most recent meeting admit that the Eurozone economy is in recession, and economists expect that the US will go into recession in the first half of next year. The Federal Reserve is expecting unemployment, for example, to rise by about 1% next year, which would be more than enough to justify calling it a recession. So the year isn't like to start on a good note, but at the same time, from the perspective of bond investors, central bankers, policymakers are starting to temper the rate at which they're raising interest rates, which is good news for bond markets, and bond markets have already started to rally and recover from their lows. But for equity markets, obviously, we've seen quite a marked rally in the last 6 weeks or so. We think that's a bear market rally. We think those hopes are misplaced. We think that markets are pricing in, obviously, the higher interest rates that we've seen this year, but they aren't pricing in the impact of recession and a noticeable growth slowdown next year. So we think that the equity markets have a little bit further to fall. Bond markets, we're happy to be neutrally placed, but it is going to be an interesting year because at the same time, we start to get the US presidential election campaign started with the opening of nominations for the Republican Party and for the Democratic Party. We have also the prospect of next winter being an even worse winter from the perspective of Europe's reliance on natural gas. and the fact it won't be able to rely on Russian natural gas. So lots of potential headwinds next year. But the good news is that it's probably fair to say that inflation has peaked. So inflation this year has been accelerating throughout the year, but next year we should be seeing inflation come down. However, perhaps the caveat there, or the health warning, is that inflation will still be higher than central banks' targets at the end of next year. And that's why they're all saying the same message. We still need to maintain high interest rates. We are not thinking about cutting them. The European Central Bank saying we expect to keep on raising them quite noticeably more than the market is expecting. So that is a downside, and that's obviously the negative news for borrowers. But at least we should see a recovery in economic activity in the second half of the year, and we should see a better environment all round for financial markets.
Excellent. Thank you for such a detailed answer, Hayden. So if we could move on to my final question now. So as we move from the end of 22 into 23, how are we positioning portfolios in that short time?
So given that we think that inflation has peaked, and given that central banks are tempering the pace at which they raise interest rates, whilst at the same time warning that they're going to have to maintain interest rates at higher levels than we have got used to for longer, we think that's certainly a better backdrop for bond markets. Now, bond markets have rallied quite noticeably over the last month or so there's not as much value as there was perhaps this time last month, but certainly bond markets are better placed, and with yields at the highest levels that we've seen in pretty much 10 years, they offer a reasonable cushion for investors, even if central banks were to have to raise interest rates more than the markets are pricing, which seems unlikely at the moment. So bond markets look reasonably fair value. Not necessarily cheap, but fair value, and much better than they have looked for a year or so. As far as equities are concerned, we still remain pretty cautious. Markets have rebounded very sharply since October. It's funny to believe that European equity markets, for example, were down more than 20% in October, but they've risen 15% since, and they are down only 5% for the year. When you consider what a terrible year it's been, the Ukrainian war, the rise in inflation, the fact that interest rates are much higher, and the fact that Europe is already in recession. So we think that equity markets have a wrong reading of sort of the temperature of the world economy and the outlook for profits. So we're still negative on equity markets, but looking 3 to 6 months ahead, we think that the slowdown and the recession will have ebbed away, with the exception of the UK, unfortunately. But that's a much more positive environment for equity markets. Equity markets usually have their strongest period when economies start rebounding from recession. So in 6 months' time, we could see some very positive backdrop for equity investors.
Excellent. Thanks, Hayden, for such a detailed update. Thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking with you again soon.